In terms of markets and current affairs, of course, one theme that has been front of investors' mind has been the recent pullback of WTI crude oil to rates which were seeing it almost go to negative $40 per barrel. This was on the back of course, traders who were speculating on the underlying commodity and using the maize future contract to do that. And that contract, of course, is reaching its last day of trading, at which stage traders who were still holding the contract would be forced to physically accept delivery of consignments of crude oil. Of course, these traders were speculating on the underlying price of the commodity and would not want to be in a position where they're accepting delivery. And this is also happening in an environment where COVID economic weakness has caused demand for crude oil to be suppressed across the globe, and filling of storage sites across the US has also contributed to downwards pressure on the price of the commodity. This, of course, saw the May futures contract trading at a price of about negative $40 a barrel. But of course, that May's future contract has stopped trading, and since then, the market has been trading the June's future contract for WTI crude oil, which today is now trading just above $15. This will, of course, continue to be something that we monitor over the next couple of weeks. Granted that COVID weakness would be a sustained theme, and some research firms in energy have been suggesting an almost 25% pullback on global oil demand as a result of the COVID-19 lockdown. What we also see and have been looking into actively is the pricing of gold as a commodity, and some of the main considerations we've been seeing here are whether gold is actually able to crack any higher than it has already, going through that previous resistance of $1,700 an ounce, and currently trading around $445 an ounce, and perhaps maybe go higher on the back of earnings coming through in Q1 and Q2, as of course these will indicate weaker cash flows for companies trading on most major indices. And with regards to CBAM portfolio performance, on a 1-month basis, CBAM 4, 5, and CBAM 3 have outperformed their respective benchmarks, while CBAM 1 and 2 have underperformed their benchmarks indices, and this is largely due to CBAM 1 and 2 holding larger positions in government fixed interest, which tend to underperform in an environment where equities are doing well. Today, US futures look like they're trading in the green, just under 1%. The Shanghai Composite in China closed negative 0.19 in today's trading, and the Hang Seng closed in the positive 0.35%. The Nifty 50 and the Sensex in India all both traded above 1.5% in the green, and current trading on the FTSE looking slightly flat, trading at about 0.29%. Of course, we'll continue to monitor these and all other factors which will impact the performance of the CBAM portfolios over the next coming weeks. And we're really looking forward to seeing some of the results of the reopening of some economies in Europe and across Asia over the next couple of days and weeks. Today, of course, US jobless claims coming in a bit weaker at 4.4 million jobless claims, and that was lower than expectation and definitely has led to an uptick on US equity trading as of today.